Retail sales came in lower than expected yesterday, suggesting consumers are feeling pressure from higher interest rates and elevated prices. For more on how that'll play out over the holiday season, let's bring in William Blair Equity Research Group Head for the Consumer Sector, Sharon Zackfia. Sharon, great to have you here. First, you just actually published your 52nd edition of your Consumer Pulse Survey. What was the biggest finding that you were able to take away from or about consumers going into this holiday season and actually amid it?
Yeah, I think generally holiday spending will be good, but we are seeing consumers appear a little bit more fragile as we get closer to the holidays. So if we look at November versus December, we're definitely seeing more pressure on the consumer and the way they're answering the questions in our survey. That's more acute for household incomes under $100,000, as well as older consumers. So consumers over 45. We're actually seeing household incomes over 100,000 and those under 29. Feeling pretty good, even on a year-over-year basis. So we're seeing bifurcation here. I think we've been seeing kind of bifurcation all year in the way the consumer has been approaching spending.
Sharon, I was reading your survey, and I couldn't help but to think back to what United Airlines CEO Scott Kirby told me earlier in this week. He told me he sees pre-recessionary vibes or numbers in his business right now. Are you seeing any slowdown in travel, and what companies are most at risk if we do get that slowdown in travel?
So, I think travel, you have to think about business versus leisure. I think business travel is still on the upswing. Leisure travel has been really, really strong all year as consumers have kind of gone back to pre-pandemic travel patterns. It's hard to say. We're still really early in kind of the outlook for 23 as it relates to travel. Most consumers travel more in the summer when kids are off, from school. So I'd say there's mixed signals there, but off of a very kind of solid 22 metric for travel. But when you think about travel, you have to think globally as well. The American consumer is arguably in much better shape than consumers in many other regions of the world. And most companies you're talking to have a global presence. So they might see European fragility or still the impact of Chinese travel restrictions on their businesses, which would be different than a company that was catering entirely to the American consumer.
Consumers right now continuing to lean into buy now, pay later services. What should we extrapolate from that and how people are buying products versus some of the services that they're seeing as necessities or have to pay for?
So we don't track buy now, pay later specifically in my group. We do track the amount of credit card usage that consumers are using this year versus last. It's actually from our survey coming down a bit for the Christmas holidays. So that's arguably a good sign, also maybe a sign that higher interest rates are scaring consumers away from using the credit cards as much. But for those that are using credit cards, they're using it more. So again, mixed signals. I think this year has been a lot of mixed signals as it relates to the consumer. But arguably, if you look at overall retail sales trends, and I know it's tempting to look at sequential or versus last year. But if you take a longer term and look at the last 3 years, retail sales, even excluding inflation, are outpacing the 3 years prior to the pandemic. So the consumer, given everything that's been thrown at them this year, is still in pretty good shape.
And Sharon, your research calls out a couple of winners and losers. Some winners are like a TJ Maxx, a Lululemon, but one company that may be starting to just hit the skids a little bit is Yeti. Why is that the case?
So Yeti had a great 21, and these surveys are designed to look at holiday sales year over year. And Yeti was expecting a slowdown in holiday sales this year, so I don't think it's out of keeping with expectations. As we look into next year, we're expecting Yeti to do fine, but probably not replicate the 21 performance that they had, where sales were up nearly 30%. The company's long-term growth plan is to grow 10 to 15% top line. And we're seeing more of a normalization, I think, to that rate.
All right, we'll leave it there. William Blair, Equity Research Group Head, Sharon Zackfia, always good to see you. Happy holidays.